Hi, I'm Bill Wilt of Assured Research. Thanks so much for joining this short video, uh, focused in this case on the lead research note from our December Assured briefing. If you're a subscriber, you'll have access to the briefing, and this might supplement your understanding of that lead note. And if you're not a subscriber, but you find this video to be of interest and value, reach out, please. We'd be happy to start you on a trial to our work. So the lead note addresses the question of whether we're returning to the 1970s. That is stagflation and all of the geopolitical discontent that went with that decade. I should say we're not actually addressing whether we will return to that, addressing rather what might it be like for the property casualty industry if that happens. It won't surprise anybody who's been paying attention that there's been a lot of ink spent in the financial press addressing the question of whether we're returning to stagflation in the 1970s. There are a lot of, especially with the recent geopolitical events, a lot of unfortunate parallels to that decade. As this is being recorded near the Thanksgiving time frame, there's been, at least on the economic front, some good news that perhaps a soft economic landing is more likely than a return to stagflation. But it still seems a relevant question to ask and answer. And I'm going to summarize some of the salient points for you, and then we're going to get into the slides. It does look, using forecasts from the Wall Street Journal, like two of the three conditions for stagflation might be met in 2024. The good news is, though, and most importantly, that inflation is expected to decelerate. So it may not happen, but we're perilously close. But when we look at the underwriting results from the 1970s, they're actually better than the 80s and 90s and look a whole lot like the century to date. That is the year 2000, the 2000s. So maybe we don't need to fear the 1970s the way our kind of our visceral reaction to that possibility usually is. In the note, we then turn attention to the question of the pricing cycle and whether, now as we enter the seventh year of rising prices, the pricing cycle is going to peter out just because of buyers' fatigue with dealing with rate increases. And the good news is we think you'll find that there aren't structural barriers that seem likely to prevent insurers from continuing to raise prices. But as always, we at Assured Research, we're big advocates in studying and understanding the aggregate demand for insurance, considering price elasticity, not just thinking, businesses have to buy insurance, therefore, we're in a great position to sell the product. It's more subtle than that. So those are some of the salient points. I'll probably summarize them again at the end of this, but let's get into the slides. Just bear with me while I share my screen, and we will jump to the presentation. There we are. Okay, you should be able to see that. There we go. Wonderful. So stagflation, we're worryingly close, but the conditions don't seem to be met. I don't know that there are hard and fast conditions for stagflation, but it seems to be the combination of a slowing economy, falling GDP, rising unemployment, but rising inflation. And as you see there on the left, GDP is forecasted to decline in 24, while unemployment is forecasted to rise, albeit from a very low level. And in fact, it wasn't so long ago, 4% was thought to be the natural rate of unemployment. So kind of in a technical matter, the two conditions on the left seem to be met. But the good news is, based on this most recent poll of economists from the Wall Street Journal, is that inflation is still forecasted to slow in 2024. So we may not hit the official definition of stagflation, and that would be just fine. But it still warrants, considering what could happen, because of course these are just forecasts and they can be wrong. So with that, what we're showing you here on the left and the right is a look back at the underwriting results by decade. On the left, we have the 60s to the 90s. So you see the 1970s nestled in there. And the observation is they don't look so bad. The combined ratio was around 100 in the 70s, much like it was in the 60s. Obviously, a spike there, but it was much worse in the 80s and with the liability crisis, and then in the 1990s. Where we had improvement from the 80s, but we still had the Hurricane Andrew is a major natural catastrophe, and soft underwriting results, and in especially the second half of the 1990s. When we look at industry premium growth, it was actually quite high in the 1970s. Now, some of that will be from because of inflation and insurers' efforts to keep up with inflation, but in the main, things don't look so bad in the 70s compared to the decades around it. And in this next slide, when we compare the 70s on the left to the 2000s, through year end 2022, again, the 70s don't look so bad. In the note we play off of the Blue Oyster Cult's Don't Fear the Reaper, which came out in 1976, and say, hey, we don't need to fear the 70s, even when the financial press screams we're going back to the 70s. Not that we would wish for it by any means, or think that stagflation is something that insurance executives don't need to worry about. They certainly need to consider it, plan for it, and maybe have an action plan should it materialize. This is just to say that when it happened in the 70s, the insurance industry worked through it reasonably well. So again, 70s on the left, the rest of this century on the right-hand side, they don't look so different, again, with combined ratios around 100. Let's now turn attention to a question that's always on everyone's mind, especially as we enter the 7th year of this hardening cycle. Maybe not all of that has been a hard market, but rates have been going up, commercial insurance rates, for the past 7 years. And one of the questions asked on a lot of third quarter earnings calls was put to insurance management teams was, hey, is there fatigue among your buyers, and is that fatigue reaching a resistance point where you're going to have insurance and reinsurance companies are going to have trouble simply raising rates? I should say, let's focus on insurance companies. Well, acknowledging that there are a lot of facets to be analyzed, and it's kind of a dynamic response is needed, or analysis is needed to really fully answer that question. What we can say here is that when we compare the profit margin, so in this case on the left, the blue line, property casualty operating income as a percentage of sales, or operating income over sales, so their operating margin, and we compare that just to the broad S&P 500, just a broad measure of corporate America, you can see that property casualty insurers are actually earn a bit less, slightly lower margin. I think it's about 200 basis points. Those lines there, the red and the blue straight lines, are the averages over this multi-decade time span, with the observation that this is the operating margin for property casualty insurers. So if we added in realized gains, it might make the series look even more volatile, but the averages would be really close to each other. So from that, we say, property casualty insurers have been raising rates for 7 years now, but their operating margin as a function of sales isn't so different than the rest of the S&P 500. So I don't think we need to worry that buyers of insurance are going to say that property casualty insurers are over earning because their operating margins as a percentage of their sales, their premiums, is through the roof, for instance, as some might surmise. I'll make a point too that the operating margins for insurers have been kind of volatile but stable over the last decade or more, whereas the operating margins for the rest of the S&P 500 have been rising. Let's look on the right-hand side. This is a more traditional way of looking at the hard market. Property casualty premiums, this is commercial property casualty premiums as a percentage of GDP. Excuse me, I think this is all of P&C premiums as a percentage of GDP. But either way, what we're looking at here, the cycles would be similar. And what you see is that you see volatility, of course. You see the cycles, the mid-70s, the mid-80s, liability crisis right around the time of 9/11. Property casualty premiums as a percentage of GDP, although clearly they've risen over the last several years. They've risen faster than GDP, so that ratio is rising. But they're still well below the peaks from the past hard markets. So again, to this question of, are there maybe structural barriers to insurers continuing to raise prices? These data points would say, no, I don't think so. And yet another way to look at it, and again, now we're getting into this question of pricing power. Look at these forecasts by analysts who follow all the companies in the S&P 500. It's data available from FactSet, where we look at their earnings before interest and tax, EBIT, their EBIT margin for 23, 24, 25, estimates for the full year 23, and then of course for 24 and 25, and for sales growth, 23 over 22, 24, and 25, year-on-year changes. We've colored in green where they're improving, red where they're slowing, either margins or sales. And you see a lot of green. Margins, almost every industry in 24, 25 expected to experience improving margins. And from a sales perspective, again, focused on 24 and 25, most industries are forecasted to enjoy expanding sales. What's the relevance of that? The relevance is that if you're the property casualty industry and you need to raise prices because loss cost trends are high, and there's a lot of natural catastrophe volatility and property related coverages, you're at least selling into industries using the S&P 500 as a broad barometer for corporate America. You're selling into those rate increases into industries that are enjoying rising sales and rising margins. And that makes that process a little bit easier and a little more likely to be realized than, for instance, the reverse. If this was all red and the industry needed to raise prices, we'd say, gee, that's going to be a hard sell when your customers are experiencing falling sales and falling margins. Obviously, that's not the case. Right-hand side, with thanks to data from ISO's business unit market stance, what we can look at is self-insured premiums by broad industry sector, where they're about 25% of the total across most industries, or at least on average, but they vary quite a bit. And the point we make in the research note is that as property casualty insurance executives and professionals, it pays to consider pricing power and to think about the alternatives that corporate America has if you're trying to sell rate increases. So the construction industry on the far left, they buy a lot of premiums. They also have a very low, at least relative to lots of other sectors, a low utilization of self-insurance. Contrast that with manufacturing, which is kind of in the middle, also buy a lot of insurance. We think manufacturing has the chance to do well in the years ahead. But they tend to have broader self-insurance programs. Self-insurance percentage there is approaching 40%. So pays to consider that. And last bit we'd share is that it pays to consider too the changes in the aggregate demand, and consider that the service industries by something like 2.5 times the amount of premium as the goods manufacturing industries, which are there in bold, construction, manufacturing, and energy. So as the economy is changing, whether we return to stagflation or we escape that fate and we enjoy a soft landing, we think it pays always to consider the changes in aggregate demand and to think about how to position your company vis-a-vis changes in the economy to enjoy some of those economic tailwinds. So that's what we had for you. We thank you so much for listening to this and for your your interest in assured research. As I had said before, if you'd like to take out a trial to our work, if you're not a subscriber, just reach out and we'd be happy to make that happen. Thanks again, and have a great rest of your day.